Hello, everyone. Welcome back to the channel where we demystify, I guess, the Canadian banking lies and give you the Canadian banking truths as it relates to everything here. The infinite banking concept, super popular. I practice it myself. Little disclaimer before we dive into things is that I don't gain anything by giving you this information. I am not an insurance advisor. I am not a financial planner, financial advisor in any capacity. I'm just simply a guy who loves money and who likes maximizing and being extremely efficient with how he uses his money. Now, one of the big topics as I've kind of investigated, I guess, as my journey into the infinite banking concept. And if you're not familiar with the infinite banking concept, check out the other videos. You'll see the theories and all this type of stuff. But really, a lot of the infinite banking content out there is related towards the US infinite banking con. Concept. And not that the concept is any different, it's just it works slightly differently in Canada than it does in the US. So, what we'll do is we'll dive into the three main differences in Canada versus the US infinite banking concept. And I've already written these out here just to cut to the chase so you can kind of see. So if you already know about these, like the video, comment below letting me know you like them. But just for the YouTube algorithm, please watch until the end. Watch time is really, really, really important. For those that didn't, stay tuned. We're going to learn all about these. So, the main difference that I have seen when you're looking at illustrations, because while the numbers don't matter, and all the infinite banking practitioners will say, if you know the problem, the numbers don't matter, and the numbers don't matter unless you know the problem or something along those lines. But ultimately, you'll notice that cash values are significantly different when you get illustrations run. In the US, you'll hear everyone talk about, 50-50 and 60-40 and all this type of stuff. And when they're talking about maximum cash value, they're talking about a 90-10 split, which is essentially where you are losing. What they would say is that 10% of your cost goes to the base premium, 90% goes to the cash value, paid up additions. But ultimately, what this means is that you lose 10% of the money you put in, 90% is still available. So you'll see some crazy illustrations in the States where, say, for a $10,000 deposit, in the first year, you'll have a $9,000 cash value accessible to you, which is bananas. Okay. In Canada, you're typically talking kind of a 70 to an 80 um split, and that's obviously 30-20. 30-20. So what that means is that typically speaking, if you put 10 grand in, you're going to end up with $7,000 to $8,000 cash upfront available to you in the first year, assuming your policy is structured correctly. Um, does this actually make a difference at the end of the day? Yes and no. Ultimately, when you look at how these policies are structured in the States, they talk about how you have a break even period. Let me move this out of the way. You have a break even period of, I believe it's like 2 to 4 years in the States. I'm paraphrasing. Obviously, I'm a Canadian. In Canada, you're typically talking like a 5 to 8 year break even component. What that means is that the premiums you pay start to exceed the amount of money you've put in. Rather, the cash value starts to exceed the amount of premiums you've put in the 5 to 8 year mark. So, for example, in all the policies that I have, the break even period is actually kind of year four, kind of, and I say kind of because it's like 0.04% or something like that. Um, Under what it would be at break even. But just know that is a difference. The second thing isn't a guarantee. So let's just put US, Canada. Oh man, this is some great stuff. Okay, so in the States, you'll hear about guarantees all the time. Now, guarantees come in a myriad of guarantees and fashions, essentially. So, for example, what is true of both Canada and US policies is that once a dividend, thus a distribution from the insurance company to its policyholders, once it's issued, it cannot be taken away. So, when you contrast that to the stock market, it's not like the dividends can be taken away from you, but the value of the stock can go down. So, let's pretend you have $10,000, you gain a 10% return. You now have $11,000 in the account in a whole life policy, even if the life insurance company does horrendous the next year. You will never drop below 11,000. Whereas in the stock market, you could get a 40% loss, let's say, and then ultimately your account is going to drop further than that. Okay. But as I understand it, and I know that there's been recent tax law changes, there's actually a guaranteed component to cash value. Now, I've seen this 4% number thrown around. For any Americans that practice IBC, let me know if this is correct. But essentially, they guarantee that your cash value will grow at least by this amount of money. Now, remember, this is a gross number. Your net return is probably going to be lower than that, but there still is a guarantee component. Whereas when you look at the Canadian component, there is no guarantee. What this means is that there's a possibility that your policy won't grow at all. And in fact, when you look at any illustrations, it says that dividends are not guaranteed. And if you look into further into it, it says that all over the place. Now, what this means is that your policy, again, theoretically, could perform significantly worse than expected. Now, when I talk about a guarantee, because a lot of life insurance advisors are going to go, whoa, wait a second, there is a guarantee. Yes, there's a guarantee that there will be some sort of a cash value associated with it, but essentially the guarantee that's provided is the guarantee that you will have a death benefit. And subsequent to that death benefit, of course, there's going to be a cash surrender value, but it's nowhere near what it would otherwise be. In fact, when you talk about the guarantee, if you only looked at the guaranteed column versus your premiums paid, the break even components like year 15 to 20 versus 5 to 8. So you're talking about a significantly lower rate of return essentially in Canada. And so a lot of people say, okay, well, wait a second, I'm not going to do this. As far as I understand, when you talk about the Equitable Lives of the world, Sun Lifes of the world, these big Canada Life companies, all these types of things, they've been around for a very, 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 very long time and have never missed a dividend payment. So I'm not overly concerned about that. In the event if a insurance company were to not pay a dividend, I think the whole stock market as a whole would be very, very, very rough. Okay. So I hope that makes sense. I'm going to scroll down here a little bit and talk about taxes. So first things first, I am not an accountant. Everyone's tax situation is going to be different. I'm going to be talking primarily about taxes as it relates to policy loans. And the reason why is because in the States and in the infinite banking practitioner's course and all this type of stuff, as I understand it, they talk about taking policy loans. In the States, policy loans are not taxable, meaning that you can, if you have $1 million, and I could be wrong here, but as I understand it, if you have $1 million in your policy, you can go ahead and borrow from the insurance company up to whatever rate the insurance company will lend on that, 90% typically, and you can go get a policy loan for $900,000 without having to worry about taxes. So in Canada, it's a little different. In Canada, we have this thing called the adjusted cost basis. And essentially, what this is the amount of money you've put in minus the pure cost of insurance. And essentially, when you borrow or withdraw above this adjusted cost basis, essentially what ends up happening is it triggers a taxable event, even if it's a policy loan. Now, this isn't such a big deal in the first year. In the first few years, because ultimately, when you talk about your cash value, so let's say your cash value is growing, okay, and ultimately, that's a horrible drawing of your cash value. Give me a second. As your cash value is growing, because remember, it's kind of got this exponential curve to it, your adjusted cost basis is just, well, at first, it actually is kind of higher than it, right? And then ultimately, what ends up happening is it drops significantly because obviously, as you get older, your cost of insurance increases. So, what this means is in the first few years, you essentially have zero taxes, right? When you're talking about borrowing, but in the later years, arguably where you'd want to be using these policy loans, you're going to have a taxable event, right? Which can be an issue. When you maxed fund these policies, your taxable event really starts to occur. And I believe roughly the year 8 to 10 mark is when it starts to become significant. And by significant, I don't mean it's a lot of taxes, but where it can become a concern and a consideration. Later in the years, it could be quite a massive taxable event. So there's a way to get around this under the current tax laws. You can go and basically go get a bank loan, and with this bank loan, you can use your policy as collateral for the loan. Collateral. Don't worry about my spelling, okay? uh, and ultimately, when you borrow the money from a third party, thus the bank, and just use it as collateral, there is no tax implication. So you can literally do the exact same things. You just have to add an extra step into it. But it is something worth noting, because if you're basing a whole strategy off of using, your insurance as a retirement income, for example, just know that policy loans, they will also become taxable. Um, Now, as I understand it, as you pay back policy loans, you regain the taxes, and thus I believe it would become a deduction off of future years' taxes. But it is something to note. So those are the three main differences. Cash value, they are lower in Canada. Um, I would argue potentially more stable, just because of the fact that I don't believe any Canadian insurance company has experienced significant stress. I know in the recent past, in the last, say, 10, 20 years, there have been a few US insurance companies that have been a little rocky. There is no guarantees in Canada, at least like there is in the US, as it relates to the growth of cash value, and there is a tax consequence. So, arguably, in Canada, the infinite banking concept performs worse. But that doesn't necessarily mean that it's bad. You just have to work it properly. And we'll explain all this as we kind of get into other videos. So, everyone, thank you so much for watching the video. I hope this makes sense. In all these videos, we always cover quite a bit of information. And I know that my whiteboard videos aren't always the prettiest, but I do hope that they are uh, educational. And if you have any questions, leave them in the comments below. And yeah, we'll catch you in the next video. Cheers.